lease versus buy decision. So what is lease versus buy decision? Okay, we already made the investment decision. We already decided, okay, we have to invest in this project. We have to buy this machine. We have to invest in this factory. Now the question is, should we buy this or should we lease it, rent it? This is known as lease versus buy decision. So what's a lease? A lease is the agreement between two parties, lessor and lessee. Lessor is the one who basically acquired the asset. Lessee is the one who uses the asset. And in return, lessee pays some annual, monthly, fixed installment as a rental, right? There's a lease contract. As far as the FM is concerned, we simply need to know about this. Now, lease versus buy decision might come in your exam. So when you need to answer it, keep one thing in your mind, that lease versus buy decision is not an investment decision. It's a financing decision. Look, we already made the investment decision. How? NPV, IRR, whatever approaches we use. Look, before lease versus buy decision, we must have to find the NPV first. Look, here I prepare a chart for you to get an idea that how we have to make a decision for the lease or buy. Look, simple. To make a decision that whether we should lease the asset or we should buy the asset. Find the cost of leasing and find the cost of buying and make a comparison and find out which one is lower. If leasing is cheaper for you, go with the leasing. If buying is cheaper for you, go for the buying. But again, definitely we have to incorporate the time value of money into our decision making, because leasing and buying will involve cash flows for many years, maybe 5, 10, 15, 20 years. So which kind of cash flows? Relevant cash flows again. So you can say it is similar like the NPV question. No. Keep in mind, NPV, when we are finding the NPV, which kind of decision we are making? We are making an investment decision, right? Investment decision, whether buy or acquire. We just want to think that should we invest in the project or not. So NPV is an investment decision. Leasing and buying is not an investment decision. First thing, keep it in your mind. This is the financing decision. We already made the investment decision. We already calculated the NPV and the NPV was positive. So NPV decision is already made. Investment decision we already made. Now we are just thinking that should we buy this or should we lease this? So one thing, it is a financing decision and we are not going to use cost of capital as a discount rate here. It's a financing decision, so we will use the borrowing rate, interest rate here as a discount rate. Now, if you lease the asset, what kind of cash flows involved? Let's say you're leasing the asset, it have a 5 year of cash flows. So what is the first cash flows? You have to pay rentals. Simple. If you lease, you have to pay rentals. And because rent is an expense, rent will reduce your profit. Your profit will reduce. Definitely your tax will reduce. And rent is the allowable expense for tax purpose. So you will get tax saving on rentals as well. So normally in leasing, we have to take these two cash flows only. Rentals, the rents on the lease asset, and the savings in tax due to the rent on the lease asset.
The life. Let's say the lease.
Yeah. Is a mention is contract. Like the lease term is 5 year, 10 year.
You mentioned the example.
Definitely, it will be mentioned. Otherwise, how could you figure out? Okay, so two things, normally two cash flows are there, maybe more, maybe more. We need to read the question. Maybe we have more cash flows there, but normally speaking, we have two cash flows arising due to leasing. We have to consider that and we have to find the present values of that. So present value of the leasing cost is normally we find out by taking the rentals and the tax savings on rentals. Okay. If you go with the buying decision, which cash flows are there? The initial investment, the cost of buying the asset is outflow. Then tax saving on the asset, the capital allowances we discussed before, we also need to consider. And maybe you have a residual value of the asset. These three cash flows we normally take. And the present value of these costs. You might ask why I haven't incorporated the operating cash flows, working capital investments, revenues, cost, variable cost, fixed cost. We are not going to incorporate here. Why? Because those are irrelevant in this decision. Whether you lease the asset or whether you buy the asset, revenues are going to be the same. Fixed costs are going to be the same. Variable cost is going to be the same. Working capital investment is going to be the same. It's different. No, it's not different. Tax on the operating profit is going to be the same. So whether you incorporate or not incorporate, it's not relevant here. So only those cash flows we will take in the lease versus buy decision, which are specifically arising due to leasing and buying and can be avoided if you make the other decision. I mean, let's say if you go with the leasing decision, then you don't have to buy the cost. You can save this money, right? You will not enjoy any residual value in this case. And you will not claim any tax saving on the asset. Who will claim? Lessor will claim now because asset is not yours now, right? So these cash flows will only arise if you buy. If you lease it, you will not. These cash flows will not arise. Simple. And if you lease the asset, right, you have to pay rentals. If you don't lease, you don't have to pay rentals. And tax saving will only arise when you lease it. So here we take only those cash flows that arise either through leasing or through buying. I hope you got my point, right? What I'm trying to explain here, the relevant cash flow decision. If you want to incorporate working capital investment in both cases, if you want to incorporate even the operating cash flows, tax, okay, decision making still be the same. The answer will be the same. So better to take only those cash flows which are specific to the decision making. Okay? Let's try this with the help of a question. So first of all, I will do a question. The firm has decided to acquire a new machine to neutralize the toxic waste produced by its refining plant. The machine would cost 6.4 million and would have a economic life of 5 years. Tax allowable depreciation of 25% per year on a reducing balance basis is available for the investment. Okay, I think this is only when you buy it. Taxation is payable on operating cash flows 1 year in arrears. So tax is in arrears. The firm intends to finance the new plant by means of a 5-year fixed interest loan at a pre-tax cost of 11.4% per year. Okay, he gave us the financing cost as well, 11.4%. Okay, I'm coming to it, with the principal repayable in 5 years' time. As an alternative, a leasing company has proposed a lease over 5 years at 1.42 million per year payable in advance. Scrap value of the machine under each financing alternative will be 0. Okay. Evaluate the two options for acquiring the machine and advise the company on the best alternative. So we have two options here. Either we can lease the asset. If we lease the asset, we have to pay 1.42 million of rentals every year for the next 5 years. But the payment should be in advance. If you buy the asset, you have to pay 6.4 million upfront today, and you can claim tax allowable depreciation here, right, Amar? So, okay, I'm going to solve it here, but keep in mind one thing. When we are making the leasing or buy decision, our assumption is what? What's our assumption? Our key assumption is if we buy the asset, we will take a loan from the bank and then buy. So, in this case, the rate of interest that we have to pay in case of buying, we will use as a discount rate. But which rate? After tax rate of borrowing, after tax bank interest rate. After tax interest rate, we will use here always for discounting purpose. Keep in mind, in exam, maybe he will give you cost of capital as well, right? And student wrongly took this in the leasing versus buying decision, which is wrong. For discounting here, this is not an investment decision. This is a financing decision. So keep it in mind that if you buy it, you will definitely take a loan from the bank, and the interest rate you have to use for discounting here. But if it is pre-tax, see, it's pre-tax here. So we have to make it after tax. How is very simple. Look, if it's a pre-tax rate, take it 11.4% and multiply with 1 minus tax rate. Simple. When you do that, you will find out the after tax rate. Okay. By the way, tax rate is given here 30%. So 11.4% multiply by 1 minus 30%. So 70% or 0.7. So multiply with 0.7. So what is the post tax rate of interest here? Approximately 8%. Can you find?
What if the company starts to buy this machine?
And there's no tax?
No.
Huh?
By their own money, not without loan.
No, again, we will assume. Look, of course, even if you use your own money, then this money, either you can invest in this project or you can invest in the bank. So what rate of interest you lose, this is opportunity cost, you will use it. So you can go with this estimation as well. So in this case, what is the opportunity cost you bear? We will use it as a discount rate. Okay. These concepts were definitely very clear when we move on next topics like business finance, risk management. These concepts we will repeat again, definitely. What's the answer? Approximately 7.9%, right? 0.079. So approximately 8%. So 8% we will use here for discounting. Okay, let's start this. So I will first of all make the buying decision. Okay, I will find the present value of buying cost and then present value of leasing cost. Okay, so look, I will start here first of all by calculating the present value of buying costs. Okay, so here I will take years, 5 years of project. Okay, we have and numbers are in millions rounded, so I will take in millions as well, no problem. So dollar in millions rounded. Okay, so if I buy this today, okay, how much I have to bear today? 6.4 million, right? And we have zero scrap value, 6.4 million today. Only take which cash flows you have to take here, uh, relevant. So maybe they also told you that we have initial investment requires in working capital. Ignore, because so better here cost of purchase rather than using the initial investment, the cost of the asset, right? Whatever we are going to use here, 6.4 million, right? So let me make it rounded because okay, 6.4 million is the initial investment and have a zero scrap value. There's a one cash flow which I need to take, and second is just the tax saving on capital losses. There's nothing else we have to take here. Amar, by the way, it's not given here. Even if it's given, we are not going to take. Even working capital investment, whether you lease or buy, in both cases it will arise. Irrelevant. Any revenues, any fixed cost, any variable cost is irrelevant for leasing and buying. So I will find the tax saving. Here I'm doing working. Okay, we can claim tax saving on 25% reducing balance basis. Okay, so reducing balance and tax allowable depreciation and tax savings. The life of the asset is 6.4 million. Okay, 25% reducing balance. So into 25%, this is the depreciation you claim first year. Reducing balance, simple, we are going to depreciate using the reducing balance basis. So what is the book value in the beginning of the year to 4.8 million? And then again 25% of it. This is you claim in second year, right? And what's the book value? Our reducing balance 3.6. Then we will take 25%, 0.9. So same you will repeat for 5 years, right? Because the life is 5 years. But keep in mind, whatever left in the end of the 5 year, you will claim all of it, minus any scrap value. We have no scrap value here. So whatever left, we will claim this in the last year. Amar, you understand it? Look, reducing balance depreciation, we simply charge. And in reducing balance depreciation, whatever book value left in the last year, the total amount we depreciate, minus any scrap value. So if we have no scrap value, so whatever book value left, we will depreciate in the last year. Okay, so this is the tax allowable depreciation. Now we have to find the tax savings, multiply with the tax rate. Multiply by 30%. This is not a new thing for us. This is we already learned. So these are our tax savings. And keep in mind, tax is in arrears, right? Tax is in arrears. So this is a tax saving for year one, but when you claim in year two. Okay, so cash flow you have to select very carefully. So this is my year two tax saving, I think so. Yes. And I have to add one more year as well, year six. Yeah, that's it. We have these cash flows. Now I will just make a total of it. You want to put line or not, it's your choice. Okay. So this is the total cash flows or net cash flows. Okay. And then I will find the NPV. Okay. I can use the NPV formula as well, right? Our discount factor at 8%, 1.08 raised to power minus n. present values. Oh, sorry. So the net cash flows multiply by the rate, discount factor. Okay. And here is the present value of buying cost. Present values of buying cost. So how much? Sum of all of them. Okay, $4.98 million is the present value of the buying cost we find out. Very simple. So if you buy the asset, these are the cash flows we expected to incur. Yeah, how I get the discount factor 8%? Because the discount factor he gave us 11.4%. We always have to use after tax, not before tax. Because cash flows we are taking after tax. So discount factor should also be after tax. Right? So 11.4% is before tax. So multiply with 1 minus t to incorporate the tax saving into it. Right? So 8% approximately, 7.9% or 8% you will get. Okay, so this is the present value of buying cost. Let's find out now the present value of leasing cost. Okay, let's find out the present value of leasing cost now. If rather than buying it, if you decided to lease it, then what cash flows we expected here? In that, we simply have to pay rentals of 1.42 million straight away. But this is in advance. Keep in mind, take the cash flows correctly. In advance mean first cash flow you pay in the beginning of year one. So where it comes? At the end of the year zero today. Cash flows always we take at the end of the year. We have assumptions. Okay, I discussed in the first two sessions. If you go through that, you will come to know. You get access to the lectures? Okay. Okay, here first thing is rentals. And second thing is tax savings on rentals. Keep in mind. Only two cash flows we have. So the first payment you made 1.42 million in advance. Advance means zero here. Minus 1.42 million. Okay. And total 5 payments. Second payment you make in the beginning of year 2. Sorry, in the end of in the beginning of year 2. So it will come in the end of the year 1 and so on. So total you have 5 payments. Okay. 1, 2, 3, 4 and 5. This 1.42 million you will pay in the beginning of year 5. So that's why we took it at the end of the year 4. And then tax savings. How much tax saving you will get? 30%. Okay. You will subtract this rental from the profits. The taxable profit will fall. Your tax will save. How much tax? Simply multiply. How much tax saving we will get? 1.42 into 30% is the tax rate. 0.43 million is the tax saving we will get. Every year we will get the tax savings. Okay, keep in mind, the first payment we made in which year? In year 1. Okay, we incorporate in year 0 because we have the assumptions. That first we assume that the cash flow will arise at the end of the year. And if any cash flow arise in the beginning of the year, we assume that it arise in the end of the last year. But when you pay the first tax, when you pay the first rental, first year. And what's the tax rule when you will claim it? So when you will claim the first tax saving? Year 2. The first tax savings will come in year 2. Okay, so 1.42 multiply by 30%. First tax saving you will claim in year 2. You pay the rental in year 1 and you claim the tax saving in year 2. So on, it will be extended to year 6. So timing is very important here. If this concept is not clear to everyone, you might ask me again. Why I incorporate tax savings from year 2? Because first rental you pay in year 1, irrespective of you pay in the beginning of the year 1. Tax department said, okay, you pay in the year 1, so you will claim in year 2. Okay, so now again I will take the net cash flows. By the way, we can use annuity factor here as well. Advance annuity, delayed annuity. It's up to you if you want to use. Discount factor at 8%, I think is going to be the same. So let me copy paste it. Yeah, I don't think so it's going to be changed. Yeah. 1.42, $4.55 million, the present value of buying cost. Okay, so the present value, present value of leasing cost. So which option is good for us? Leasing or buying? Leasing. So leasing is the good option here. So we will decide to go with lease the project, lease the machine rather than buy it. Okay.
Sir, what if we don't have tax? Like,
Which tax? Tax on operating profit? Which tax?
any kind of tax.
We Yeah, then we don't need to incorporate, yes. If we don't have tax, then how we will incorporate? Before tax adjustment. It may have some additional tax as well. So we need to incorporate. See, if any additional tax arise due to leasing only, due to buying only, so we have to incorporate. If there's no tax, so no need. Okay, that is the leasing versus buying decision. And I think we have a question here from December 21 past paper, Hawker Co. This is for the lease and buy decision question. No, we can try this. If you buy, you have to pay 34,000. Not wrong yet. 34,000. And it also have a scrap value. 14,000. 4-year life, right? 14,000. You can add separate column as well. Okay. Okay, and tax saving, they said it is straight line method, right? So we will use straight line method of depreciation. Not reducing balance. So the tax allowable depreciation will be straight away, which is what? Initial investment minus scrap value, because in straight line method we subtract scrap value. And reducing balance we don't subtract. We scrap value we subtract in the last year only. So 14,000 divided by 4 years. 5,000 of depreciation we claim every year in the 4 years. So tax savings, what's tax rate? 20% of it. So I think 1,000 simple into 20%. So 1,000 is tax saving we will get every year. And tax is in areas, right? Tax in areas. Hmm. Areas. So that means the savings you will get from year two onward. The first tax saving you get in year one, but you will claim in year two, and so it's 5 years in total. Okay, we don't need year six now. Yeah. Is there anything else? Yeah, you have to pay the tax on CO2 tax as well. This is tax allowable depreciation, sorry, tax savings on tax allowable depreciation. No. We also have to take the CO2 emission tax. When you have to pay each year. At the end of each year of operation. Mean at the end of year one, at the end of year two, at the end of year three, and at the end of year four. Is the outflow. And it's tax deductible. So basically, we also save tax. We deduct 600 outflow, but we save tax because of it, right, Amar? So tax saving should also be incorporated, right? So we can do 1 minus T, but no, we cannot. Why? Because tax, if in the same year I can do 600 into 1 minus T, but tax is in arrears. So we will pay this tax, but the tax saving will get taxed here. So the tax savings, I will take a separate column. Tax savings on CO2 tax. CO2 emission tax. I think so. We are going to do this way, but let me check as well. Okay. So this tax saving you will get in year one. Year one you will get in year two. 600 into 20%, 120. Because these are also in areas.
You will get.
You will get every year for the next 4 years. 120. You did in the same way?
No.
So what mistake you made? This is my net cash flows. Right. Okay, rate of discount should be the borrowing rate, which is given 4%. Yeah, after tax. So, okay, I will find directly here using the formula of NPV is equal to NPV 4%, 0.04, comma, cash flows except the initial investment, and initial investment subtract now 34,000, 20,302. I think that's the present value of buying cost. Okay, you agree with me or not here? Okay, that's the present value of buying cost. I find out. Now find out the present value of leasing cost.
Yeah, I get it 21,418, but I've done the same.
21,400 and then why I'm getting different? See, maybe you didn't take the cash flow in the respective years. Maybe check 120. You maybe put in year one.
Oh, I added the addition of this one, 4,000.
You added. I also deducted 34,000.
Okay, I'll see it later.
Let
20299.
okay, fine. You did rounding something. Oh, then fine. Yeah, okay. Let me see. No. Is equal to NPV. Where's the initial investment you subtracted? No. Okay. No, but where's the no. You can't do like this. Initial this NPV formula. This is not the NPV formula. This is equal to NPV will find the present value of future cash flows.
Okay.
So look, when you do that, what it's assumed? It's assumed this is a year one cash flow. This is year two. This is year three. Understood? So
I have deducted later.
yeah, you deduct later. Always, I told you in the class when I did the NPV. You did rounding in discount rate, maybe? Where you did discounting? Where you did rounding?
Similarly.
Like I haven't. I don't think so. We have to do any rounding. Show me. Where you did rounding? In the present values. Okay, you take the discount rate here.
Yeah.
This is the rounded one.
Oh, it's the original.
Then why it is rounding then? It should not come like that. No, look, this one I'm telling you, this 120 should come in here. Okay, you know it's year two, yeah, correct. Everything is correct. 14,000, 1,000, 600. Tax savings is here. 120 here. It's look okay, by the way.
Yeah, maybe some calculation error.
Maybe, but not a big difference, so not to worry about. A second part, leasing. We have to pay renters of 6,000 at the end of, in the beginning of the year, 6,000 here. Here, sorry. Present value of leasing cost, where it is. I remove years here. Oh my God, here it is. 0, 1, 2, 3, 4, 5. So you have rentals and tax savings on rentals. I don't think so. We have anything else. Rentals we have to pay in advance. 6,000 outflow. 4 rentals. Or you can copy this. And tax saving should be from year 2 because tax in areas. So 6,000, you can also do like this, 6,000 into 20% is the tax sales rate. Saving is 1,200. It should be like that. Okay, net cash flows. Present value. This is not NPV formula. This is the present value of future cash flows formula. When you give this 6,000, it assumes this is a year one cash flow. It starts, this formula start calculating like this is my year one. So don't give it year one if you are going to use this NPV. Year zero, you have to take any year zero cash flows, take at the very end. Okay. If you are going to use this formula. Okay. First of all, discount rate 4%, 0.04, comma start from year 1 cash flows, and finally year 0 cash flows you subtract or add in the very end. 18,462. This is the present value of leasing cost. So which one is cheaper? Leasing is cheaper. So Hawker Co should lease the new vehicle because this option has the lower present value of cost. Okay, it's a 10-mark question, by the way, in the exam. Discuss two reasons other than possible after-tax advantage why Hawker Co may choose to lease rather than buy the new delivery vehicle. I mean, other than this beneficial cost, can we say any other reason that they should lease and not buy? Any other reason? Look, he said, give any two reason other than this beneficial. Any two reasons why Hawker Co may choose to lease rather than buy. Yeah.
The liquidation, cash,
In case of liquidation,
listed. Because we have the liquidation cash for it, cash. You can invest it other than buying.
okay. Look, I mean, you're trying to say if you buy it, you have to pay a lump sum payment of 34,000, and in case of leasing, you don't have to pay, you only have to pay 6,000. So this cash flow you can use somewhere. Maybe in capital rationing is a good to go. Yeah, you can say that. Good point to raise. Look, I think he wants us to ask some other factor. Like, okay, technology is maybe one factor. Look, if you buy, then the risk and reward of the asset is yours, right? But if you lease for 4 years, and maybe if you want to cancel, if you don't want to lease the asset again after 4 years, so you can do it. Look, if you lease, you don't have to bear any obsolescence of the asset, any risk and reward of the asset you don't have to bear. If you are in a technological advanced world, after 4 years, if a new machine will emerge, so better to go with leasing option because we don't have to invest a big amount in the beginning, and this technological related cost we can avoid. Right? Let's see what he said here. Reason other than after tax cost, he said leasing can offer more flexible than borrowing and buying. Lease period can be for less than an asset life, or break um, clauses may be offered by the lessor. Look, so in this case, if technology changes and the asset become out of date before the end of its expected life, the lessee does not have to keep on using it. If you buy it, then you have to either sell it at loss, maybe you have to scrap it at very low loss, very high loss, or you still have to keep using it. We have to mention only two. What second he said, under the borrow and buy option, Hawker Co would carry the risk of vehicle falling to achieve a disposal value of 14,000. 14,000 we expected. Maybe it is lesser than what we expected in this case. So we don't have to bear the risk of 14,000 scrap value that we might lose. The lessee may not have enough cash to pay the vehicle and might have difficult to obtain the bank loan. By the way, we have to mention any of the two, okay, to get the required mark. So you need to give any of the two reasons to explain this. Third part, 6 marks, discuss three advantages of using NPV rather than IRR in investment appraisal. Yeah, three advantages. Look, when he say like this, so we have to basically make a comparison. We need to give benefits of NPV over IRR. If you give straight benefit of NPV, you will not get marks. Look, first you need to understand the question carefully before going to answer it. So three advantage of using NPV rather than IRR. NPV is absolute measure, one benefit. Okay, over the IRR is not an absolute measure. So if it's an absolute measure, it ignores the So what is the absolute measure benefit? That it incorporate the size of the investment. So IRR is not incorporating the size of the investment. Okay. Number two, NPV can be easier to calculate, easier to work out as compared to IRR. Right. In mutually exclusive projects, NPV is a better measure as compared to IRR. Right. Even in capital rationing circumstances, many benefit, by the way, you have to mention only three of them. Right. And we already discussed in detail in our the first two session. If you go back and discuss, so this total 20 marks we get in section A, B, and C. I think so. Yes. Okay, so this is the end of the first topic. We have lease versus buy decision related to our NPV.